This is Money Untold. Before we break down what just happened in Shanghai and its impact on global markets, make sure you follow us on X or Money Untold and subscribe on YouTube for full analysis.
Silver Western spot is sitting at 88.50 as I record this. Western futures at 88 even. Shanghai spot came in at 86, Shanghai futures at 88. And tonight, for the first time since Lunar New Year, the Shanghai Futures Exchange reopens. In the last video, we talked about what that moment could look like. Now it's here. Silver got slammed multiple times today, knocked back down to an 85 handle more than once. Both times it came back. It's now reclaimed 88.50 on Western spot. That tells you something. When price absorbs repeated suppression attempts and keeps recovering, you're not watching a weak market. You're watching a market where the bids underneath are real. Gold is at $5,228 Western spot. 2 trading days ago, both metals were meaningfully lower. Over those 2 sessions, gold is up roughly 4% and silver is up over 11%. Bitcoin, over that same window, is down. Now for the short-term tape readers. What follows here is strictly educational. It is not a signal, not advice, and not a call to action. This is for people learning how price structure and body closes work in real time. In the last video, we mapped out the resistance zone clearly, 87.20 up to 89. Price is inside that zone right now. We have not yet seen an hourly body close above it. That matters. Camping inside a resistance zone without forcing through it gives shorts time to reload. What this market needs, if the bull thesis is going to play out, is a decisive close above 89. Not a wick, not a momentary print. A body close that confirms the zone is no longer overhead resistance. If that happens, 90 is the next structural level, then 92, and the door opens for continuation. Until that close happens, the zone is still doing its job. Watch the hourly, watch the body. That's the education. In the comments, 3 words. I'll know who's paying attention. Now back to the broader picture, because the structural story underneath this price action is what actually matters. Silver's COMEX implied volatility index broke above 100 again. Think of this like a fear gauge for the silver options market. When it's low, traders expect calm. When it spikes this high, the options market is pricing in violent, potentially disorderly moves ahead. It doesn't tell you direction. It tells you the structure underneath is under stress. And after the last video, where we talked about the naked short problem and the mechanics of how forced liquidations work in commodity markets, that stress has a specific source. March silver open interest, 3 trading days before first notice day, is still sitting at 44,500 contracts. That represents over 223 million ounces of paper silver. Open interest did decline by around 3,300 contracts on Friday, but the amount still outstanding heading into first notice day is significant. Most of those positions will roll or close without physical delivery. That's how the paper market functions. But every contract that doesn't roll becomes a delivery demand. And COMEX February silver deliveries have already reached 23.5 million ounces this month. The physical delivery pipeline is active. And then there's the SHFE side of this pressure. We talked about naked shorts last video. Beyond Shiming is the name behind the largest one. A Chinese billionaire holding 450 metric tons short on the SHFE, against total exchange inventory of roughly 350 tons. His position is larger than all the physical silver sitting on that exchange. Regulators have frozen his ability to add and raised margins. Can he hedge? In theory. But at this scale, with no physical buffer and cross-exchange capital requirements, the exit is not clean. The exchange reopens tonight. Watch closely. Adding to that pressure, on Friday alone, 2.25 million ounces were drained from COMEX silver warehouses. CNT, Delaware, HSBC, and JP Morgan all saw withdrawals. Total COMEX silver inventory now sits at 364 million ounces. The drain is not slowing. The physical is leaving the building. Peak silver production globally was back in 2016. We're not expected to return to that level until 2030. Meanwhile, industrial demand has gone from 47% of total consumption to 67%. Solar, EVs, data centers, defense, electronics. Supply hasn't kept up. The market has run deficits for 5 consecutive years. Paper pricing hasn't caught up to that reality. That's the core of the structural problem. Mexico update, brief, because we covered the foundation last video. El Mencho is gone. Roads are blocked, mines are halting, cartels are extorting shipments in affected regions. Mexico supplies roughly 45 to 50% of U.S. silver imports. The risk exists on paper. Whether it translates into actual supply disruption is still an open question. What's new? Trump publicly offered to send U.S. military into Mexico to take control of the cartels directly. His words were, if Mexico wanted help with the cartels, we would be honored to go in and do it. That is not a small statement. Whether it materializes or not, it signals the situation has escalated to the point where the U.S. administration is openly floating military intervention. For a country that produces 1 in 4 ounces of silver mined globally, that level of instability and geopolitical entanglement is a supply input risk the mainstream is not pricing into paper silver. Watch this space. Geopolitically, the tariff environment has not calmed down. Trump threatened significantly higher tariffs against the EU in response to their move to freeze ratification of a trade agreement with the U.S. following a Supreme Court decision. He's been explicit. The U.S. will hit harder than before if countries try to play games. That framing matters because it embeds trade war escalation risk into global capital allocation decisions in real time. And separately, U.S. military hardware in the Middle East continues to sit at elevated positioning levels. The Iran situation hasn't resolved. It has paused. Pauses with that kind of forward deployment don't always stay pauses. Now look at what's happening in broader markets simultaneously. Anthropic launched Claude Code, and the downstream impact on specific sectors has been significant. Cybersecurity stocks saw over $52 billion wiped out in 2 trading sessions. CrowdStrike down 20%, Cloudflare down over 18%. IBM fell 10% on the news that Claude can now convert legacy COBOL code, directly targeting IBM's core modernization business. These are not small sector moves, and Bitcoin fell below $64,000 today as leveraged liquidations accelerated. This matters for the metals narrative because of where capital is going instead. Gold adding over $500 billion to its market cap in a single hour earlier today. Silver adding roughly $130 billion in the same window. When paper assets, equities, crypto, are under pressure and hard assets are simultaneously surging, you are watching a live capital allocation decision being made at scale. And then there's the AI economic risk layer. And this one connects to the metals thesis in a way most people haven't stopped to think about. AI is not failing. It is working, but it is working faster than the traditional labor economy can adjust. White-collar workers represent roughly half of U.S. employment. The top 20% of income earners drive over 60% of total consumer spending. If AI tools systematically reduce the cost of tasks historically performed by high-income cognitive workers, software development, security analysis, code modernization, and that displacement happens faster than new high-income roles are created, you get a wage-based contraction that feeds back into housing, credit, and government revenue simultaneously. That's not a prediction. That's a logical sequence worth tracking carefully. This is not a guarantee of collapse, but it is a structural risk that puts more pressure on the dollar, more pressure on fiscal deficits, and more demand for assets that don't carry counterparty risk. That is the environment metals are designed to outperform in. The displacement loop, AI improves, companies cut costs, spending weakens, companies protect margins by buying more AI, is deflationary for labor income and inflationary for hard assets. You don't have to believe that scenario plays out in full to recognize that investors are pricing in that possibility right now. The capital flows are saying it plainly. Meanwhile, Chinese investors have been buying gold ETFs at a pace the World Gold Council described as historic. Chinese gold ETF holdings rose 52% between late August 2025 and the end of January 2026. That is not retail noise. That is institutional and retail capital in the world's second largest economy moving into gold at a record clip during a period when both geopolitical uncertainty and domestic economic questions are elevated. And the GSR, the gold to silver ratio, after being stuck between 80 and 100 for years, dropped to 44 to 1 when silver spiked to $120 on January 26th. We're now back around 60 to 1. That ratio compression from 100 down to 44 and now stabilizing in the 60s tells you something has changed in how silver is behaving relative to gold. It is no longer the chronic laggard it was for most of the past decade. Now the honest case for caution, because that's what this channel is for. The COMEX implied volatility spike cuts both ways. High volatility means the market is pricing violent moves in either direction, not just up. A coordinated intervention by large institutional players or a liquidity event in another asset class could push silver back sharply in the short term, even if the structural thesis remains intact. Shanghai reopening tonight could open with more caution than the physical demand signals suggest. If Chinese institutions assess the gap that formed during their holiday absence and decide to be measured in their response. And the Mexico supply disruption, while directionally concerning, has not yet shown up in confirmed mine output data. The risk exists. The confirmed impact does not yet. Mark Douglas made this crystal clear. Even your best trade setup can lose. The edge isn't about being right on any single trade. It's about playing the probabilities over time. Right now, the fundamental case for silver is as strong as it's been all cycle. But when price catches up to fundamentals, that's always the unknown. Anyone giving you an exact date is guessing, not analyzing. Bottom line, two things are converging. A physical silver market that is structurally tighter than the paper price reflects, with documented supply pressure from Mexico, active COMEX delivery demand, warehouse drains accelerating, and a SHFE reopening into a significant price gap with forced short covering on the clock. And a macro environment, tariff escalation, AI-driven labor displacement risk, capital rotating out of equities and crypto, that is actively hostile to paper assets and favorable to hard ones. Those two forces are pointing in the same direction. The open question isn't whether the structural case is sound. It's whether tonight's Shanghai Open confirms what the physical market is already pricing in. That data will be available in a few hours. Verify it yourself. This is financial warfare education, not advice. Protect your capital. Do your own homework. Don't take my word for any of this. The CME reports, the World Gold Council data, the Silver Institute supply-demand figures are all publicly available and verifiable. Invest with logic, not hype. OG out and about.